everybody. Welcome to an Ask Me Anything on asymmetric investing. The goal here is really to be able to answer your questions, whatever you've got on your mind, whether it's what's going on in the market today, what's going on with the asymmetric portfolio. I've got a couple of things that I kind of have planned, but the day is really for you. So want to be able to answer as many questions as possible, trying to make sure the stream is up and running if there are audio issues or anything like that. I had the wrong mic one time I did this, so hopefully I've got the right mic this time. But I wanted to start as we have questions coming in. I've got a couple in the queue from the asymmetric investing community. But I wanted to start the discussion here today with what's going on in the market, because I think this is sort of a strange day given the fact that Alphabet reported last night. Alphabet, I think now the number 2 position in the asymmetric portfolio. I actually sold some of my Alphabet stake earlier in July. And part of the reason for that was the valuation was not, I was buying shares of Alphabet when it was trading for 15 to 18 times earnings. That valuation has basically doubled. And the question about how much the company was going to spend was really the thing that I was thinking about. Are they going to get to the point where they're going to be negative free cash flow? And they actually did that. That is something that happened this quarter. I'm going to try to pull up some of the charts that I've shared. Posted an article last week on asymmetric investing about the market was actually expecting Alphabet to be able to remain free cash flow positive, despite the fact that they were also expecting growth, a ton of growth in the company's capex. So here was the consensus. This is part of an article that I put out on the 18th. The consensus free cash flow estimates for 2026 is a little under 25 billion, I think is what the number was. More or less, that's probably somewhere around where we're going to end up. This is full year numbers. So they were positive free cash flow in the first half of the year, and about a negative $4 billion in free cash flow in the third quarter. But then the market was expecting free cash flow to still be positive in 2027. The reason that I thought this was worth highlighting last week was the expectations for capex. So the expectations for capex was almost 200 billion. I think they've now raised that to right around that $200 billion number. Their range, I think, goes right around 200 billion. So that's about what we're expecting this year, maybe a little bit more. But then the market's expecting that to jump another 250 billion. Now, these are analyst estimates, so this is just their estimate of what capex is going to be. But if your capex is going to go up $50 billion and you're still going to be generating $25 billion in free cash flow, that means that the core business has to make that up. And that's the thing that I just think there was a lot of optimism going into the earnings report that all of this capex was going to magically turn into free cash flow, operating cash flow very, very quickly. Because if you look at, that first chart that I shared, the projection is that the free cash flow ramp kind of bottoms out 2026, 2027, and then the free cash flow ramp just goes up like a hockey stick up and to the right. So the investments that are being made today are not only not going to continue growing, but they're going to lead to a ton of free cash flow. And so we have a lot of questions about that. And that has implications up and down the market. So when you look at what's going on with some of these stocks, pull this back up, the heat map. Some of these companies, is Alphabet going to continue spending? Well, if they don't continue spending, then that's going to flow its way down to all of these other companies that have been extremely hot. So this sector right here, so semiconductor equipment companies, this is going to be, your memory companies. This is software, so this is maybe a little bit less impacted. But a lot of, this whole area, what's going to go on with infrastructure, whether you're looking at Oracle, put Micron in this, there's going to be a lot of questions about Alphabet is expecting to increase. They said they were going to increase their capex significantly, I think was the word that they used, in 2027. And that may not be all that possible, to be frank, because you're going to have to take out debt And Alphabet has the ability to keep increasing their capex because they're one of the biggest, most profitable companies in the world. But what happens to Oracle? I put a video out about Oracle earlier today. Oracle's debt costs are going up and its stock price is declining. So if you're going to fund that artificial intelligence investment, hundreds of billions of dollars of AI investment, the money's got to come from somewhere. You either got to be able to sell stock or you got to be able to issue debt. The downward spiral that companies end up going into is when they're issuing debt and those debt costs are rising. So the comparison that I always make is to Sun Edison. The Sun Edison's business model was, hey, we're going to sign this contract for a wind farm or a solar farm. We're going to sign a 20-year contract, not a 3 or 4 year contract, a 20-year contract, sometimes even longer than that. So we're going to know what our cash flows are going to be, and then we're just going to issue debt and issue equity. And if we add together those costs, the yield that investors are expecting in both debt and equity, let's say it's 8%, and we're going to have a project that returns 10%, that's a profitable trade to make. I can do that in perpetuity. You can do that until the moment your debt and your equity now costs 12% or 15%. And so those rises in the cost of capital, the cost of debt going up, stock prices going down, is telling you what the market is demanding. The question now is going to be not necessarily what does Google do, but what does CoreWeave do? What does Nebius do? What does Iron do? What does Oracle do? Because this is an arms race at this point. And if the market is starting to question whether this arms race has an actual payoff or an actual ROI, that's going to be a question that we're going to have to answer. So this is one of the reasons that I've stayed out of a lot of the AI trade, because I think a lot of it's not really sustainable. It's dependent on these companies spending more and more, and eventually we get to the point where there's either an ROI or there isn't. And not everybody in a value chain can be making boatloads of money. So you can't have the hyperscalers crushing it, high margins, chip companies crushing it, high margins, memory companies crushing it, high margins. That's just not the way that this works. You're not going to have those extremely high margins from absolutely everybody. So those are my general thoughts on where we are in the market today. I think a lot of questions that need to be answered. And we'll see. This is going to be a push and pull from a lot of companies in the market over the next few months. Okay, a couple of questions, and there was a question that came in from a reader as well about Mobileye. This is a company that's in the Asymmetric Portfolio. I have the theory behind owning Mobileye is that autonomous driving is going to be a really big deal in the future. So I own kind of 3 stocks in that little basket: Uber and Lyft, because I think they're going to be the aggregators of demand. So they're going to be the app that that millions and millions of people, hundreds of millions of people choose to interact with to actually get an autonomous ride. Waymo may be a piece of this. I guess I also own shares of Alphabet, so that's a piece of that thesis, but it's not a core to the thesis because it's such a small piece of Alphabet. But I think you're still going to have these ride-sharing companies. They're going to be how these dozens of suppliers actually get to market too, right? We're not going to have 10 or 20 new apps that are all trying to build their own networks and operate a fully vertically integrated business model. That's just not going to happen. So I think those 2 companies are going to still play a role in the future. There may be companies that vertically integrate. So think about Waymo in there. Tesla is also trying to vertically integrate. We can talk about Tesla later if you would like. Not great data coming from their robotaxi business right now. Their growth is actually slowed. But if we go to a world where the supply is essentially a commodity, so you can get a GM autonomous vehicle and a Volkswagen autonomous vehicle and Stellantis autonomous vehicle, then you go, okay, who's developing the technology, that piece, and then can modularize that and sell that to a whole bunch of different automakers? And Mobileye would be one of those companies. There are a couple other companies that have sort of a similar strategy. I think you could say that like a Neuro, who was working with Lucid, has a similar strategy. They would love to sell that to a whole bunch of different companies. That's the long-term thesis. The short-term challenge is they still have this core business that they're operating. So this is what we got the quarterly report for the most recent quarter. So they're doing about $2 billion worth of revenue on an ongoing basis. Beat their estimates by just a little bit, I believe, if I remember correctly. Earnings per share was slightly negative, but they do have positive free cash flow. So, that's going to be primarily the stock-based compensation and those non-cash costs. But they're also investing. The other thing you have to keep in mind is when you look at an income statement like this, they are investing a lot to develop the technology that these companies could put in their vehicles in 2028, 2029, 2030. And so that R&D investment happens right now. The payoff will be years into the future. So that is the way to think about it is, and sometimes the market doesn't think about that potential payoff in 3, 4, 5 years. Again, this is the advantage of the way that I invest, but it's also what can be painful in the short term. So I think the results were pretty solid, but there was nothing really crazy about it. They did raise the midpoint of their full year guidance, just kind of tweaks to their guidance. So not a lot that I took of it. I have not had a chance to listen to the full conference call because the other thing is Professor Amnon Shashua said that he was stepping down. That is a piece, at least a piece of why the stock is down. And I thought it was very interesting. If you look at the pre-market trading, the stock was actually up 10% for about a minute pre-market. It was kind of a strange trade, but I got a notification that when I woke up, the stock was up 10%. And I was like, oh, results must have been pretty good. It was actually, I think, a reaction to Shashua stepping down. I would say one of the big things for him in particular is the acquisition of Mentee, which happened, I believe it was announced last year, closed earlier this year, if my memory is correct. Not a good look. That was a company that he helped found, and then his public company acquired it. It's the kind of thing that Elon Musk does, and the market cheers him. It's not the kind of thing that most founders do or that the market cheers in general. So that, I think, sort of put him in a strange position. We're also getting to the point where, his explanation was the company needs an operator. I'm an entrepreneur. So when we're doing new stuff, when we're talking about new technology, that's what I get excited about. I don't get excited about the nuts and bolts of how are we going to build this physical car, because they're now starting to vertically integrate. I don't think they're going to have an app. There's not going to be a mobile app, but they're going to have somebody build a vehicle. They're going to own and operate that vehicle in theory, in a fully autonomous network. And then they're going to, maybe they plug into Lyft. They have a deal with Lyft, for example. So I don't really want to do that. I want to play around with the technology and do the stuff that Mentee is doing and stuff like that. So the company is in a weird spot because I think when you look at, let me pull up the numbers from Fiscal AI, because the valuation is pretty compelling. I'll share this. Fiscal's actually got a little bit of this is not correct. I think the market cap is closer to $7 billion if my memory serves me. But if we look at their revenue, and then let's pull their free cash flow. And let's look at the balance sheet too, because this is the other piece that I think you need to keep in mind when you're looking at a company like this. Okay, so the business is pretty steady. So blue is going to be revenue, steady as it goes, but nothing crazy. And what I think is really going on here, so they've signed a couple of deals, one with Volkswagen, one with Stellantis, which was announced yesterday or the day before. Not necessarily the biggest deal in the world. It's kind of like a step up from their traditional ADAS, advanced driver assist systems, but it's not going to be your hands off, eyes off, things like that. So it's kind of a step up. And then there is a major US automaker. Not sure exactly who that is, but that's going to be another, I think it's a surround ADAS deal. So those are 3 deals that are going to lead to higher average sale prices. I'll pull up some of those metrics in just a second, and be pretty good volume. So we should see, based on their pipeline, based on sort of the numbers that they've already announced, the revenue should go from about 2 billion to about 3 billion, just based on those kind of next step up systems over the next few years. That should lead to, better margins, better free cash flow. Like I said, still free cash flow positive, and you still have the optionality that you get with, robotics. Maybe that's a thing, maybe it's not. And then also all of the autonomous driving, the more advanced autonomous driving, but still a really good balance sheet. Look at this. $1.4 billion worth of cash just sitting on the balance sheet. So let's go to some of those key performance indicators, because I think this is where, when I look at the company, number of systems shipped. I may have to do math here. Wasn't prepared for that. Okay, number of systems shipped, 38.3 million. Okay, so the average price per system, IQ and supervision system right now is about $50. So the real thesis for this company is that you go from a system that costs $50, which is, you may have it on your vehicle today. You may have a Mobileye system on your vehicle today. It's just a single camera in the front, doing lane assist, doing smart follow, stuff like that. And that price point should go up significantly as we get to more advanced systems. So surround ADAS is going to be the next step up. Then you have supervision, and then all the way up to the fully autonomous level 4 vehicle, which would be probably tens of thousands of dollars. Maybe that starts to come down, but $10,000, and then there would potentially, if it's in a robotaxi system, be recurring revenue as well. So again, that's the upside, is that the core business, not necessarily all that exciting, but it's got positive free cash flow, has a positive cash balance, and then you get a lot of optionality to the upside. So I never like to see a stock that I own going down, but I continue to look at this one and go, are we in the case where the thesis is fundamentally broken? I have not seen that yet. Are we at the point where there's a lot more delays than investors thought? We thought we were going to have, a dozen companies with robotaxis on the road today. That's probably more the case. And a lot of the OEMs have not been nearly as aggressive getting to those autonomous features. GM reported earnings earlier this week, and one of the questions in the conference call was about, hey, when are you going to get this Super Cruise, which seems to be pretty successful and people really like it? When is it going to be in more vehicles? And they were kind of like, it's coming slowly. So it's very interesting how we're at this point where we know that these more advanced features are coming, but they're just a lot slower than a lot of people think. So maybe that's an advantage for investors long term, because Mobileye does continue to sign these deals. They continue to be, if you are a big OEM and you need to have a solution that works, are you going to go with a startup that's maybe based in China, or does most of its research in China, like Pony AI would be an example, or are you going to go with a Mobileye? I think it's pretty compelling to go with Mobileye, but that doesn't mean that it's been a great stock recently. To kind of answer the question about, is getting a new CEO the right move? I think it probably is, and we'll see who that is. But lots of questions, and investors don't like questions right now. Just look at what's happening with Adobe stock. Who's going to be their next CEO? What's the business model going to be? When there are questions, that's when you get a stock falling for seemingly no reason, and because there's just uncertainty out there. So hopefully that answered your question, bmark0610. So thanks for bringing that to the table. You also asked a question about Celsius. I actually sold my Celsius not too long ago, and part of the reason for that was I just didn't see, if you look at the core growth rate, it's not what I think it could have been, and that market is just getting more and more competitive. My wife works at Target and brought home a random new brand that they're bringing in, and I was like, oh, this is pretty good, and this is going to be the kind of thing that competes directly with Celsius. So that was not my decision maker, but it's just one of those things that buying Alani Nu, I think, was a phenomenal deal for them. There was a nice bounce in the stock after that. So I think, I took some nice profits, and happy to have the profits there, but not necessarily one that I see the potential that I saw a few years ago. Matt Hard, thank you for the question. Thoughts on HIMS going into earnings? I'm excited about HIMS going into earnings. The stock is obviously more than doubled from its low. I think if you look back, especially in the newsletter, I highlighted this one pretty extensively when the Novo Nordisk lawsuit happened. The risk that we saw in the first quarter was a temporary risk. That was a patent lawsuit. I think I did an entire AMA on that. So you can look back in, I want to say January or early February to that one. But I think a lot of what I said there ended up being kind of the right way to think about it. It was Novo Nordisk saying, "Hey, you can't do this," and Hims and Hers going, "Okay, we're going to push things as far as we can, but we're the one that has, 2, 3, 4 million subscribers now after the Eucalyptus acquisition and incorporating Zava and stuff like that. We're the one that has this customer touch point. You need access to those customers. So what are we going to do? How are we going to figure this out?" And the deal that they figured out was Hims and Hers took on the same row business model, which is a $150 subscription price to be part of their weight loss solution. And then you can have access to a number of different solutions. So Novo Nordisk is one of those companies that's providing the solution. So and then Eli Lilly as well. Eli Lilly's deal is a little bit different. But let me pull up um, the numbers that I think investors should keep an eye on when earnings are reported, and this has been pretty consistent. The things that I watched. So first is going to be the number of subscribers. So if you look at the trend here, it was 2023, or is it 2024? 2024 that they introduced GLP-1s. So a ton of growth in this period through the first quarter of 2025. End of 2025, first quarter of 2025 is when the exemption ended. So the exemption to compound these GLP-1s ended at that point. That's why the first quarter was a particularly hard comp, because anybody who was interested in getting in before that exemption closed did it in the first quarter of 2025. Then things kind of flatline. And you see it in a couple of different areas for Hims and Hers. You see it in in the subscriber growth, which was pretty consistent. 200,000 subscribers or so, growing quarter over quarter, and then you get it slowing throughout the end of 2025. A little bit of an uptick in the first quarter of 2026. I think that was a little bit surprising, but I think we're going to see that reaccelerate in Q2 2026. So we'll see if that happens. The other thing that I'm going to keep a close eye on is what is the monthly revenue per subscriber, and how are they reporting that? $300 is the minimum price that a customer is going to pay to be on the weight loss solutions on Hims and Hers. If they're adding a ton of subscribers at $300 a pop, that's going to bring this number up. So you're going to potentially have two catalysts on the revenue side: the number of subscribers and the revenue per subscriber. So that's where, you look at a company like this trading for, what are we at right now? 3.3 times sales. If revenue kicks up, I wrote an article not too long ago about how revenue could grow 50% or more in the second half of 2026. And you put all the numbers in there. That's how you get there. And if that's the case, if we get 50% plus growth, and that's what they're guiding for the second half of 2026, I think this company deserves to trade for a lot more than 3.3 times sales. But we'll see what the numbers look like. I think it's early August, if I'm not mistaken. But yeah, that's definitely one I'm going to be watching closely, and keep an eye here on YouTube, and then also on the newsletter for what's going on with Hims. Yeah, answer the question. A couple of questions about Mobileye. So hopefully the question that I answered earlier got to all of that. Thank you for the comment. Hopefully everything I'm doing is a little bit helpful for you as an investor. Celebrate, not one that I've looked at it in the past. Let me just pull it up here. I think that I have done. So this is the security company, develop solutions. Here, let me share my screen so you can see this. Develop security solutions for legally sanctioned investigations. So this is the company that I believe helps, help break into things like iPhones, right? Like if the police want to get into your phone, Celebrate's the company that's going to do that. I think it's an interesting company. I think it can be a really solid business. Price to earnings multiple on a forward basis 24. That's great. Relatively modest growth rate for that kind of a price, from 15%. So that's why it's not one that I've put in the asymmetric portfolio, but definitely one that I have looked at in the past. Really interesting business. Just doesn't quite fit what I'm looking for with that upside in particular right now. Take on Coinbase and the Clarity Act's impact on their business model. I have in my queue to write something about Coinbase soon. So Thomas, put that in. I think it's something that I will come back to in a little bit more detail. In general, the more clarity, if we can use that pun, that Coinbase and the entire industry has, the better. And my entire thesis on Coinbase has not been about crypto trading or Bitcoin. It's been about the blockchain. What are we going to be doing with the blockchain? How is that going to disrupt traditional finance? We're starting to get to that point. I mean, we're starting to get to that point where companies are having to respond, where there's real payments happening on the blockchain, where there's real infrastructure. Look at all the things that Stripe is doing. I think they're always kind of the canary in the coal mine for me. They're the one that I keep an eye on because they're the ones that you interact with when you make a lot of your digital purchases. It's Stripe. It's not Visa. It's not American Express. Visa and American Express happen behind the scenes, and they're the rails that Stripe is running on. But Stripe's stablecoin payments right now are about half the cost for a merchant. So the person they're actually buying something from, than a traditional credit card. So there's an incentive for that merchant to use a stablecoin versus taking a credit card. It's a long way to go from here to the point where everybody's actually using stablecoins, but we're moving in that direction and answering these questions, saying, these are the digital assets that you can and can't own. Here's the rules around them. I would love to see more experimentation with business formation, which I think is something that may come out of this. But I don't feel quite smart enough today to answer exactly where we're at with that Clarity Act and what the potential impact will be. Part of that is because it changes so quickly. So until things are finalized, I don't want to necessarily respond. But I think Coinbase is in the right position. They're one of the biggest infrastructure companies. We're at the point where the entire market is down. They've got a good balance sheet. So if there's something that they need to buy to build these things out more, I'm finding more and more companies that are built on Base, which I think is interesting. Jarcy is a company that I did a little bit of work with, doing private market ownership, and that entire company is built on Base. So you can see what you own. You can buy relatively easily. We're still in that nascent phase of what's actually going to be built on the blockchain. What is stablecoins going to be used for? What is the Base blockchain going to be used for? What is the promise of those NFTs of 5 years ago? There was a real there. It maybe wasn't profile pictures, but if let's say asymmetric investing, I say, hey, I'm going to sell 1% of asymmetric investing, and I'm going to put my entire income statement on the blockchain, and I'm going to just pay out every dollar of profit to each of those owners on an ongoing basis. That'd be a really cool way to raise funds for a business. Again, we're not there yet, but I think that's where we potentially could be going in the future. So stay tuned, both here and on YouTube, and then I'll probably cover it a lot more, especially as earnings come out on asymmetric investing. All right. What do you think of the industrial stalwarts that have been collapsed this year by the AI bubble, namely Copart and Rollins? Let me pull up, not an area that I have looked at a whole lot. Auto auctions. I don't know that these are necessarily. Copart isn't necessarily an AI story. And the interesting thing, Pest and Wildlife Control Services. Again, I don't know that those two stocks in particular are going to be an AI story. What has been interesting is the industrial companies that have benefited from the AI build-out story. So like Comfort Systems is always the one that I kind of go back to, but anything that kind of sort of fits in that. I'll pull up Comfort Systems here and just kind of explain their business, because this is, as much as I don't necessarily think that those two stocks in particular are all about AI, unless it's just like, you're thinking of a rotation out of a business into something where there's maybe more exciting growth. Maybe that's a piece of what you're asking. But what we have seen is a bunch of these industrial companies that have had massive run-ups, 2,300% since 2021 for Comfort Systems. Comfort Systems isn't a super complicated business. They're basically doing HVAC for data centers. So, you know, construction, modular construction, building automation services, building services. So this is one of the companies. You got to put liquid cooling in your data center. This is going to be one of the companies that could do it. The thing that has changed, and this is the thing that everyone should keep an eye on. So I'm gonna pull the growth rate, and then I want to show gross profit and operating profit, because the question that I have about so many of these companies. So let's hide these bottom two first. So the growth rate has obviously picked up since 2021. That is without question. But the reason these stocks are up so much is because the margins have exploded. So look at operating or gross margins. Historically, I'll even pull this back further. We can go back to 2010, let's say. Gross margins are 17, 15, maybe 21%. Now we're looking at 25% gross margins. So their pricing power is absolutely crazy. And when those gross margins go up, your operating costs don't go up all that much. So now you go from being, a mid-single digit operating margin company to a 15% operating margin company. So your revenue picks up and your margins pick up. That's why your stock is up. The question is, what's sustainable here? What is a 15, 16% gross or operating margin sustainable for a company that effectively does commodity construction services? I don't think it is. And when you look at then the price trading for 50 times trailing earnings, 40 times forward earnings, that's where you get to a point where, some of these stocks that have run really far get to be really questionable to me. To just come back to the two that you brought up, there are a bunch of areas where I'm looking for, maybe not industrial companies, but companies that are much more sustainable than the market thinks, but have sold off. So an example would be like Lyft is down like 7% today. Why? Like nothing changed about Lyft today. Still trading for like 5 times expected free cash flow for the next 12 months. That's one of those companies where I just don't think the AI disruption story is as valid as the market does today. But we'll see. This is where I think we're getting into bubble territory with a lot of different companies, but then there's a lot of deals out there for companies that I think are much more sustainable than the market currently thinks at this point. What do you think about Nokia? I have not thought about Nokia in a very long time, to be honest. So I don't have a lot of thoughts. Don't generally like the companies that are, kind of their best days are behind them, and I don't know that I see exactly what they're going to make that's going to turn things around for them. But I don't know. Maybe it's something that I'm completely missing. Maybe I'll keep this up and check out Nokia. Not even sure their full structure at this point. So yeah, that's one I maybe don't have a great answer for you. Bought at 15, so it looks like if I'm not mistaken here, shares are about 9, trading in euros. Yeah, I don't have a great answer because it's not one I've dug into. 25 price to earnings multiple, growth rate on a 3, 5, and 10-year basis, all negative. I don't know. That's a turnaround story. That's got to be what you're looking at. All right. Thoughts on SoFi, and what's your take on it? SoFi, I have actually been buying a little bit recently. Let me just go through a couple of the numbers that I'm interested in here. SoFi trading for a price to book value of about 2. So if you look at that historically, that will bounce kind of between 2 and 4, depending on the quarter or what's going on with the market. But the things that I keep going back to with SoFi, so they report 3 different segments. I'll just pull all these together here. And so lending is kind of the traditional business, and what they were built on was the loans that nobody else wanted to do. So personal loans and student loans. And they've moved into more traditional loans. It's still not a huge business for them, things like mortgages. But as they have more and more members, that is going to be an area where I think they can actually do more lending and make some pretty decent margin. The question is, how big can that business be, and how much does it really matter? Because the other piece that they have is the loan platform business, and this is something that they disclose, the volume that's going through that. And the loan platform business, so basically, if you originate a loan through SoFi, it looks like SoFi has the loan, but they actually sell the loan on the back end. So you still interact with SoFi. This is the way that most mortgages work. I mean, we got our mortgage from a mortgage broker, and then it ends up with Penny Mac or Wells Fargo, something like that. It's actually cheaper. Weird structure, but it's cheaper to get a loan through a mortgage broker, and then it ends up with the Wells Fargo than just going directly to Wells Fargo, which doesn't make any sense to me, but that's where we are with the loan business. So that is a business that's going to probably continue to grow, and they'll just continue using their balance sheet. But the real piece to watch is this financial services business. This is going to be all the fees related to credit cards. It's going to be fees from the loan platform business. It's going to be stock trading fees, crypto fees, any blockchain, stablecoin revenue that they get, all that kind of stuff goes into this business. And that's where, if I isolate that, and I'll just pull trailing 12-month numbers so we don't trailing 12-month, and I'm going to pull in the financial services contribution profit. So this is what's so impressive, is that this just continues to grow like crazy and is compounding like crazy. And this is driven by all the new products that they brought to market and then all the advertising. So one of the things that I like about SoFi is they're doing things very differently than most of their competitors in the banking space. They're not a big bank. They're doing everything digitally. I think when I originally wrote about them, and I added them and Robinhood at the same time in the Asymmetric Portfolio, and they were building branches in the area that I live. There's like physical branches for U.S. Bank and for Bank of America and stuff like that going up. And I'm like, why are we doing this when so many of these digital solutions are so much better? I've got accounts with both SoFi and with Robinhood. They're so much better, so much more compelling. I like the app better. The credit card is better. I use Robinhood Gold. Why are we building out these physical branches? And it's like, that's their only way to respond, is to try to have a different kind of service and a higher end service. But that doesn't mean, Robinhood and SoFi are going to start with kind of the lower end consumer, the person that's going to get a personal loan. And then they're going to slowly move up market over the next 10 to 20 years. And then it's just going to be a long, slow process. It's going to be volatile from a stock perspective. But that's why I continue to add when we get these opportunities where the stock is down, because I don't see anything fundamentally wrong with what's going on with the business. So that's one I've been adding recently. I think my cost base is still, I want to say, under 10, but yeah, I like their future. SpaceX. Is it too early to take a position in SpaceX? I was considering buying some shares today and then selling calls and puts against it. I can just say what I'm doing personally, which is absolutely staying away from SpaceX. I have no interest in owning a company that's trading for, it's probably under 100 times sales at this point. But just look at Tesla. They are not the thing that we were promised 5 years ago, 10 years ago, even 15 years ago. They're an automaker. What is SpaceX in the future? They're a rocket company. So they're going to put lots of satellites into space. They're going to have a satellite constellation that's going to require continual maintenance, right? You're going to have to, those satellites don't last forever. They last, 3, 4, 5 years, and then they fall to Earth and burn up. You got to upgrade them periodically. It's building out Verizon's network on an ongoing basis, and they own the satellites. They don't, Verizon doesn't have to own the towers. They're also renting. Well, SpaceX isn't renting spectrum, but some of these other companies like AST Space Mobile are renting spectrum. You know, SpaceX had to buy that spectrum. Then you get into the artificial intelligence business. Is that a good business to be in? Do you want to own? They're effectively a neocloud now. I mean, that business, the neocloud business, is bigger than the space business or Starlink. So I just don't. You know, you're talking about $1 trillion company that I can't tell you what their actual business is going to be in the future. Something rockets, AI, maybe merge with Tesla, and I don't know. I don't love that as a business. You can just buy Google. Um, that seems easier to me than trying to speculate on what the market is going to like about Elon Musk's next idea. Because you're not getting it's not a good value. There's no it's not free cash flow positive. I don't see what the moat is. There's a dozen companies that are putting up networks, space telecommunications networks, and guess what? They're all going to be slower than just connecting to the 5G that's down the road. I've got 2 fiber lines in my yard. It's never, ever, ever going to make sense for me to be using satellite unless it's connecting to my watch. And what am I going to pay for that? $5 a month, $10 a month, and then that company is going to get a handful of dollars of margin. You're going to put all these things on all airplanes, which that already has been done. On boats, again, that's already been done. In residential areas, a lot of that's been done. I don't know. I don't like the business, but you know that's what happens when you have a fundamental investor in companies that aren't necessarily about fundamentals. I own On. I assume we were talking about On Holding, the shoe company, and I expected earnings to cause a reset. I'm gonna just pull up these numbers here. On has been one of these companies that I've owned for a while. I think going on 3 years at this point, and I don't get what the market doesn't like, um, except the fact that it's a shoe and apparel company. But I'll pull up. I got revenue continues to compound. I'm gonna actually put this in US dollars. This is my one complaint about On. I would like them to report in US dollars. Nobody globally, people are not buying On shoes with Swiss francs. So let's just report it in US dollars where most of their investment dollars are coming from. It makes way more sense. This is their biggest sales market. Quit making this so complicated, guys. Um, their growth continues to grow. You always have to look at the constant currency growth numbers versus the numbers, because you have a weak dollar, so that makes that makes the sales look lower. But the company continues to grow. The margin continues to be good. But look at this gross profit margin. This is always the one that amazes me. Who has pricing power in the shoe and apparel business? On does. They said they wanted to get to a 60% gross margin. They're now at almost 64%. It'll be interesting to see, if they grow nicely this quarter and this gross margin number comes down to 61%, which would still be phenomenal. Is the market going to have a negative reaction? I don't know. I can't predict the market's reactions at this point, but enterprise value to sales is 3-year compounding annual growth rate is 20%. I think that's probably reasonable to expect that in the future. Price to earnings multiple on a forward basis is 19. I don't know. I'm happy to own this stock. Maybe it'll take a while for the market to figure it out, but I don't see any weakness in their business right now. But some of these apparel companies have been kind of out of favor. There's a lot of questions about how much consumers are spending right now. What I don't think is in question is that the higher end consumer is continuing to spend, continuing to buy new shoes. We live in suburban soccer area, and there's a lot of On shoes, a lot of brand new On shoes. So including me, I like buying On shoes. So I'm putting my money into the shoes and hopefully helping the stock as well. But we'll see. Again, another one that I'm going to cover quite a bit when we get to earnings season. Thank you for the shout out there. Hope you're enjoying the show and everything that I put out there. We speak to Tesla's earnings report yesterday in your special situation with respect to Tesla. I have not gone through the full earnings report. I was listening to other conference calls last night. I got through Google, and I'm starting to dig into Mobileye. So this is not one that I have looked at yet, but oh my gosh, shares are down 14%. I mean, look, things are playing out the way that I thought they would. To just be honest, let's do trailing 12 months here. I mean, this is not a growth company, and they don't have great margins. If we look at this on a quarterly basis, because they've always got some kind of one-time things, their margins are okay, but their sales are kind of blah. It's not a growth company. FSD not going the way that they expected. I saw a chart yesterday. I don't have it on hand. So maybe I'll write about this a little bit later this week. But their rollout, the number of miles that they're doing with the robotaxi business has kind of flatlined. That's not what you want to see. You want to see that accelerating, because there's a whole bunch of other competitors. We talked about Mobileye earlier. They're coming to the market. They have a solution that is AI driven, cameras first, and they have a redundancy. They have, radar as a redundancy. That's not something that Tesla has today. So I think this is one of those companies you still look at it trading for 12 times sales and 156 times earnings. Guess who is growing faster than Tesla right now? General Motors is growing faster than Tesla right now. Their enterprise value to sales is under 1, and their price earnings multiple is 6. I mean, so my special situation is a long-term, I'm long puts, so I'm short the stock via puts. This is a risky one to be short via puts. This is the second time that I've done this with Tesla. I took a 260% profit early in the Trump administration. It was timed well, where Elon had gotten into the administration, and I thought that was probably not going to go great. And then they had some bad quarterly numbers, and a couple of months later I closed it out for a 260% profit. So we'll see if this continues. Obviously, the market doesn't see what they're seeing today, with the stock down as much as it is. I just looked quickly this morning, and the position is up really nicely today, but I'm not gonna, it is down long term, so I'm not gonna, pound the table about having called that one correctly, because the timing was not great on my part. All right, I have a few stocks that I believe are asymmetric that aren't talked about much. So the foreign ones: Jumia, Nintendo, SQM, and Neo. I was wondering if you could check any of those out. Let me talk about the two that I'm familiar with and the reason that I'm not invested in them. All right, I'm going to start with Nintendo, because Nintendo is one that I really like their product. I think the video game industry is in a really, really tough spot where it's not actually growing right now. And you can go back a decade. I remember writing an article for the Motley Fool highlighting that Call of Duty used to have an annual release, and they would release the number of sales that they had in the first 3 days, right? So it's like the pre-sales, and then you get the people who want to buy it right away from Best Buy or whatever. So it was like, we did 800 million units. I'm going to get these numbers wrong, but directionally they'll be correct. And then the next year it was like, we did 500 million units. And then the next year we did 400 million units. And then they just stopped reporting them, because what you saw was people were just buying games for consoles less and less. Part of that is there's just so many more things you can do with your phone. So the video game industry has gone from, when I was a kid and the NES came out, that was the system. Everybody had an NES. Everybody played the same games. Rocket ship, because it is culturally, everybody's doing the same thing. Now everybody's doing different stuff. Maybe you're really into Roblox, right? But if you're into Roblox, then you're not into Nintendo. If you're maybe into Call of Duty or whatever other games, then you're not into the other thing. This is what Xbox has run into. Okay, so stock is down pretty sharply. This is where it starts to pique my interest. Okay, I'm interested in Nintendo. Why is the stock down 50%? Is this because memory costs are going up, so their margins are going to go down? Well, that's going to potentially reverse in the future, so maybe this is a good buying opportunity. Here's the reason that I have not decided to buy Nintendo. They came out with a new console last year. I think it was last year, right? You have a nice spike in your quarterly sales when that comes out. And then you have not a great quarter after that. I also we're very early in this Switch 2 cycle. By the way, these cycles last a long time. If you get the Switch 2 wrong, or any of these products, any of these consoles, if you get it wrong, it hurts you for a decade. Switch 2, I think, is really compelling, but is it so compelling that it's going to attract new users or get me, we have a Switch 1, to upgrade? And the answer is no. And I think that's the real challenge now is I want to like Nintendo. I want to like the tailwinds they have from things like the theme park. We went to the Universal Studios in Florida, and the Nintendo area was done really well. That's going to be an incremental positive for them. The movies are going to be an incremental positive for them. Those things are not going to drive the business. What's going to drive the business is, are people buying consoles? Is the console sold out at Target, at Walmart, at Best Buy? And right now, 6 months or so into its sales cycle, or less than a year, I guess, it's not. It's not sold out. You can go and buy one right now. That's not a great sign for Nintendo. So I still like the company. They're going to have pressure on their margins because of these memory costs. 20 times earnings is fine, but you look at their 5-year compound annual growth rate, it's 5.6%. Is that going to pick up? I'm not sure that it is. So this is one of those, video games. I'm a little bit skeptical that this is going to be a growth market. I like that they have a niche. You know what Nintendo is going to do. It's one of these trustworthy brands. What, right? We got younger kids. When you look at video games, do I want my son playing Nintendo or playing something random on his iPad? I'll take Nintendo every day of the week, especially because we know the games that he's going to be playing. And as the younger kids get a little bit older, much happier if they're playing Nintendo than playing some silly game on an iPad that probably has ads that you can't really control. I am totally anti Roblox for our family. So uh, I think that's the real question for me is there something that's so compelling that people have to go out and buy it? And the answer that I've come back to is no. Nokia or Ericsson. Tommy, what's the compelling argument for those two? Why are these two coming up? I'll dig into it. I want to know what the thesis is on these two companies, because I haven't seen anything compelling from. I haven't heard the name Ericsson for a very long time. Naval, I think this is a follow up to the question I talked about earlier. I have no idea what's going to happen with earnings short term, and I have no idea what's going to happen with what the market's sentiment about a specific stock is going to be. That's I don't know. My best investments have been dead money for multiple years and then suddenly become rocket ships. Axon was like that, right? People are talking about Axon now. I was buying Axon in 2013, 2014, 2015. Nobody gave a hoot about it, and they reported great quarter after great quarter, and then suddenly it got attention. How do you think HIM's earnings are going to be? I talked about this a little bit earlier, so if you want to go back in the replay, do you feel like this is still a disruptor, a company that can maybe be disrupted by Amazon? I think these are two completely different business models. And one of the things with Amazon has gotten so big that they can't do the same kind of disruption that they did a decade ago or 15 years ago. And what I mean by that is, like, go back to when they bought, was it diapers.com? I think it was. And they were just trying to sell diapers. And Amazon was like, yeah, but you can buy everything here. And that really worked. Buying everything here and also getting your pharmaceuticals here is a completely different story. We actually use them for an ear infection drops. So one of those things where it's 7:00 on a Thursday night, and you can't just call the pediatrician and go, hey, can you send in a prescription to the pharmacy that's down the street from us and I'll pick it up in an hour. Like that's just not the way that the system is set up right now. But you can do that with Amazon. That's what Amazon is, I think, is really good at. But that said, it was a pain in the butt to set it up. So the two that I own that are sort of in this realm that I think could be better being specialized is Owlet. Maybe not, on people's radar, but there is a telehealth service that they are launching right now. I think they're kind of like in beta right now, so it's not wide release yet. But you can set up each of your kids has a profile, and I think you can use it until they're 18. And you could do exactly what I did and say, okay, I'm going to call in to the Owlet telehealth person or send in pictures of my son's ear. Go, here's what's going on. We need some ear drops. They ask a few questions, and boom, that gets sent to the local pharmacy. In theory, in the future, maybe it even gets delivered to your door in under an hour. I think Amazon could potentially have a role in that infrastructure piece and the delivery piece, but I think that medical relationship makes a lot more sense with companies that do medicine and not that do everything. It's just like buying a home, right? Like, why is Google not gonna disrupt Zillow? Because when you go buy a home, you're gonna want to go to a company, an app that does homes and not that just does advertising and does AI and does absolutely everything else. Maybe I'm wrong about that in both cases, but that's the way that I think about him. I think Hims is going to be in a really good position, and their move, they announced this week, I think that or at least it was reported this week, that they're going to be changing the Eucalyptus brand and another brand that they have in Australia and a couple other markets to the Hims and Hers brands. They're going for a global brand. Again, this is a perfect asymmetric stock. This is either a company that's going to be worth 100 billion, maybe even $1 trillion 10 or 20 years from now, or it's going to be gone. So that's exactly the way that I invest. And I would love to have 30 companies like that fit that go, this is either going to be an absolute home run or it's going to be a zero. And there's kind of nothing in between. But that's the risk reward. And right now the market, earlier this year, the market was thinking about that zero a lot more than they were thinking about the upside. See what happens after this next earnings report. Thoughts on the pawn shop business, like First Cash and Easy Corp, both have run up a lot due to gold and could offer protection against a recession. Not an area that I have ever played. Just I don't love the pawn shop business model. So that's one of those areas. I own gambling stocks, but have not gotten into the pawn shop business. Okay, I think this is a clarification on the question earlier. Meant capital rotating into AI instead of these reliable industrials. That's really fair. That's really fair. There is a level of rotation that's going on with money going into Micron and CoreWeave and Iron and like all these companies that are related to the AI build out, and that means that it's rotating out of some of these maybe more stable businesses. For me, that's meant it's been a bad year so far from a return perspective. But I think that this is great to buy some of those companies that are going to be able to compound their revenue consistently over the next 5, 10, 20 years at really reasonable multiples. I mean, just think about a really, really simple one like Uber. Like, do you think Uber is really going away because AI? We're going to like put your address in Claude and say, hopefully somebody comes and picks me up. I just don't think that's the future. Same thing with artificial or autonomous vehicles. Like I said before, we're not going to have 50 different autonomous vehicle companies coming into the market. So you're going to have an aggregator like a Uber sitting in the market and capturing a lot of this value, building that consumer relationship. What are you actually going to choose to click on as a user? Those are the companies that you're going to want to own in the future. Uber, I think, is one of those companies, and it's trading for, I think, under 20 times earnings. Great, under its long-term compounding annual growth rate. Love it. So maybe there are industrials in that space. I'm sure there absolutely are, but those are the ones that I'm looking to buy today. So maybe we're on the same page. Like, what do you think about Joby at these prices and Google's quarter? I will write a little bit about Google's quarter. I may do a video on them here if I have time today. I think Google had a solid quarter, but I don't love the reason that I sold shares earlier this month was I don't love that they're going free cash flow negative to win this AI arms race. I would rather own Google than any of the other companies in AI because I think it's just an easy button. And the worst case scenario is that they go, okay, we're going to cut our capex to $100 billion next year, and instead of being, zero free cash flow, now you have $100 billion in free cash flow. So they're one of the winners if that capex spending starts coming down across the industry. But the other pieces that their core businesses just weren't knocking it out of the park. YouTube, ironically, I think it was 13% growth. That's okay. Yeah, that's pretty good. It's probably better than a lot of the other streaming companies, but it's not amazing. Search, same thing. You're kind of seeing a slowdown, a deceleration in search revenue. So that opens up a lot of questions. And what do you want to pay for that company? We're still trading for about 30 times earnings. And there's questions about what the AI payoff is going to be in the future. So I think it makes sense, the market's reaction today. But we'll see if that continues. Joby is one of these long-term ones. Again, a little bit like hims and hers, but probably even more so. This is either a zero or a home run, 10 years from now. But does it go to, 3 before then? Maybe. One of the things that I've really liked, I'll just pull up some of their numbers if you're not familiar. You're watching this and you're not familiar with Joby Aviation. I'll even pull up their website. They make an eVTOL vehicle, so an electric vertical takeoff and landing vehicle. Think of it a little bit like I compared them to part helicopter, part private jet. And I think the reason for that is you do have the vertical takeoff and landing. So the vertiports, as they're calling them, that the infrastructure that they're building out, they actually bought a company called Blade, which has deals with these helipads, and then also has kind of a network of helicopters that will pick up people and take them, around cities like New York. But that is sort of that demand side of the business. And then the theory here would be that you can take off and land vertically on a helipad on the top of a building. They had a deal with one of the buildings in Los Angeles, so I think that sort of lays the template for what this is going to look like in the future. And then these blades can turn forward and fly you like an airplane. They're going to show that. Yeah. So this picture kind of shows that here. Not a lot of range. I guess this one does too. Not a lot of range on these aircraft. I think it's less than 100 miles with just the battery. But there's the potential for these to be run on hydrogen. So hydrogen is going to just turn hydrogen into electricity. So same powertrain. You just have a little bit different, fuel cell in it, guts to it. But you don't have to get like fully new approvals or anything like that. They've done a test that I think was 250 miles. So that gets you to the point where you can go, all right, now you're not just talking about JFK to Manhattan. You're talking about going from New York to Philadelphia or Boston or Los Angeles to San Diego. Now you're talking about a little bit more, I live in the Minneapolis area. Can we fly to Chicago? That would be amazing to be able to like hop on an Uber app and go, hey, I want to take the family to Chicago in 30 minutes. Can I hop on a Joby? Like that's we're talking 10, 20 years from now, but that's kind of the long-term vision. Again, pre-revenue company, but in theory, and we will learn more again in this conference call, they don't have a lot of press releases. They're not winning the press release war against Archer Aviation. That is for sure. But they are executing really well. We know what the business is going to be. So I like that about the company. But lots of questions to answer. So not generated revenue yet. They may hit commercial operations by the end of this year, in theory. That's maybe going to be a stretch, but maybe one of those cases where they do like one flight. It's like an automaker saying we're going to produce an R1 in 2023, and you just produce one, and you go, see, we did it. So we'll see what happens. But I think fun company to own, very high risk, but I think high reward if things work out well. So that's why it's in the asymmetric portfolio. Thoughts on Lyft? Any projections on price closer to the year end? Any info would be appreciated. I don't do price projections, so I'm planning on holding these companies long term. If something changes, like if the stock goes up 3x, 5x, then I'll maybe rethink things a little bit. But I don't make price projections because I don't find that to be useful because I don't know. I don't know if the market's going to appreciate what I'm buying and what I'm not. The only thing I know about a price projection is it will be wrong. That said, I think the valuation is pretty compelling. If I can pull things up here, I will pull up their metrics. Uh, price to free cash flow is really strong. Let's see here. If you look on a forward basis, they had some wonky stuff in the fourth quarter related to the revenue in California, and also their insurance reserves are pretty volatile. So this is one there we're looking at the forward multiples, maybe a little bit more accurate than looking at a PE multiple of 2 on a trailing basis. But PE multiple is 8, price to free cash flow on a forward basis is 4. I mean, I don't think they're going anywhere. The other thing to look at, again, revenue is a little bit volatile. But if we look at gross bookings, this has just been, I'll do trailing 12 months. This has been just growing consistently. It's not growing like crazy, but 16% compound annual growth rate is pretty darn solid. Number of riders continues to go up as well. Sorry, that's number of rides. Active riders continues to go up. It's going to be volatile quarter to quarter, but continues to rise. So you want to look at the year over year. So March 2025, 24.2 million. Most recent quarter up to, if I can get it, 28.3 million. That's what you want to see. The trends are moving in the right direction. The market is obviously pricing this company as if it's in real financial and strategic trouble. I don't see that in the numbers. At worst, hopefully they buy back a ton of stock over the next year or two. All right, we are already going over an hour. So I will try to power through a handful of these questions quickly. Yes, I did already talk about Alphabet. So go back. You can go back in the replay now or later and see my thoughts about Alphabet. But I will also be doing more content both on YouTube and then on the newsletter. Would probably be the best place to get all my content. If you are not a subscriber in the newsletter, definitely encourage that. Asymmetric-investing.com will get you there. The thing that I added recently, I should pull this up and actually get an update from questions, is there's a new community feature that Behab brought up that I have jumped on. I was probably one of the first people that signed up for this. But it's been this is one of the things I've been waiting for. So we're only a few days into this, but it's been really great to be able to have discussions with people, put my thoughts for the day. So I quickly put out, after Alphabet's results came out, hey, here's what I saw real quickly. Here's the releases if you want them. Here's the charts from Fiscal AI that show kind of the trends for the business. I'll even periodically put, kind of preview some of the content I'm doing, news that I find interesting. And then there's premium things, links to the newsletter. All the newsletter articles go out in here as well. So if you are interested in, joining this community, I'd love to have you if you're on YouTube, but maybe you come from the asymmetric investing side as well. So if you're not signed up for this, definitely recommend that, because I think that'll be a really fun way to communicate with everybody. All right. Are there any questions that I missed on? Talked about Mobileye. ServiceNow. David asked about ServiceNow. On my radar. It's gotten to the point. Let me pull up the. Price to earnings multiple is 20 now. It's getting compelling. I do think this is one of those companies that the disruption story is a little overblown, but here would be my argument is, does this multiple drop to single digits? I mean, I don't know. I think Adobe might be even stickier than ServiceNow and is trading for 8 times earnings. Or a company like Intuit. Again, I'm interested in Intuit. I haven't bought in, but they're trading for 10 times earnings. Some of these companies, and I've got to look through my kind of watch list of these software companies to look at which ones I'm maybe interested in adding to the portfolio, because there's some of them have just gotten beaten up so much. But just always remember that, like, there will be a point where some of these are like a no-brainer buy, where you go, why in the world? I think people are at that point with Adobe. Why in the world is this trading for 8 times earnings? And we'll eventually get there with some of these. Okay. I think I answered at least a handful of these. Biotech, medical is something that I'm looking into more. So I don't, and Lemonade, I have talked about that one online a bunch of times. I don't get what their differentiation is. Maybe I missed it. But I think the stock has done really well. So congrats to everybody who was in that one, who was trying to convince me to get in that I just didn't understand. But I don't necessarily know exactly what the moat is there. And some of their actual operating metrics have just kind of kept me away. I haven't seen the inflection that I wanted to see, but maybe wrong on that one. What do I think of the Jersey Mike's IPO? I actually may do a video on this. I love Jersey Mike's. We eat it regularly. I have part of a leftover sandwich downstairs to show you how often we go there. I am not interested in this IPO at all. I think it puts them at about an $8 billion market cap. They are not consistently profitable. Their metrics, they say like system-wide sales is $4 billion. That's system-wide sales. That's not Jersey Mike's sales, because this is a franchise business. So they're only taking a small percentage of that. Why are you not printing money if you're a franchise business like this? I looked through it at a very high level and I did not like anything that I saw. Now, if it's $1 billion market cap, now I'm interested. One of the things to keep in mind with these kind of IPOs is that private equity companies are selling. So they took Jersey Mike's private. I don't remember the details of that, but they're trying to get out. They're trying to find exit liquidity. So you are their exit liquidity in the IPO. This is another one. I'm learning that lesson with Portillo's, right? Maybe just sit on it for a while until it gets to that no-brainer price, because it may get there. Don't know what happened there. So if you did have a comment, let me know, and I'll see if I can pull it up. I do not have thoughts on AIRJ. So I was using Comfort Systems as a broad. There's a whole bunch of companies that look like that. You can look at like GE Vernova is another big example of a company that has short-term tailwinds, but is it sustainable long-term? Got a lot of questions about. Do I think the Neo Cloud moat have a moat long-term? No, simply I don't. If it does, tell me what it is, because they're renting GPUs on a relatively short-term basis. This is not a platform that you're building a business on top of, the way that you would maybe be building a business on top of AWS in 2006. Netflix was built on top of AWS. Snapchat was built on top of AWS. They didn't have to buy data center equipment the way that Facebook did, because they were built with the assumption that AWS existed. Most of these NeoCloud deals are with companies that are also building their own data centers. I mean, Alphabet explicitly said this in their conference call. We are going to use some of these third parties, aka NeoClouds, as a bridge. We are going to use you while it is beneficial to us, and as soon as it is not beneficial to us, we will bring that capacity in-house. That tells you everything you need to know about the moat of that business. These commodity businesses renting out GPUs is going to be a phenomenal business until the moment that it isn't. I've written a ton about this. I've done videos on this. The economics of commodities are the way they are for a reason. There's a reason that commodities go through boom and bust cycles, because everybody sees, look, they're making a ton of money right now renting GPUs. I want to get into that business. So then you put money into that business. So does everybody else. You look at I did an article called Exponential Squared, I think is what it was. And you have an increase in CapEx going on right now. So this is, take everybody together, one big lump. The amount of money going out into building data centers is increasing exponentially. The amount of compute coming out of each chip is increasing exponentially. the efficiency of the models is increasing exponentially. So it's 3 exponentials that are combining together. So you're telling me that you assume that you can know that with those 3 exponentials on the supply side, that you know that the demand at a certain price, remember the price part matters, you're going to be able to predict the price, the market clearing price of a data center, of a GPU in 2028, 2029, after all these companies have spent trillions of dollars building out capacity that just like didn't exist 3 years ago. I don't know. That's not a business that I want to be in. Because I don't see what the mode is long term. If we get to a point where some super, companies start pulling back, what happens to the neoclouds? They're the first ones to go bankrupt. So that's my very strong thoughts. CRDO, Credo Technology. I've looked at this in the past, but I do not know enough to say much. Really good growth. Yeah. Don't know enough to say much. Elf, I believe you're talking about Elf Beauty, not my world. So I don't have strong thoughts on Elf Beauty. Sorry. Sometimes you got to know what you don't know. And I don't know beauty products. All right. Thanks so much for all the questions. Really appreciate it. Revolve, not a company I've dug into. Another women's fashion brand. It's not. How am I going to tell you what to do with women's fashion brands? What do I know? The reason that I know about On is because my wife bought me the shoes, but I'm the one that wears them. But she makes the decision about what gets purchased. But I don't know what she's going to purchase. So when there's that crossover and it makes sense to me, I'm happy to have an opinion. When I'm trying to say what's going to happen with women's fashion, now we're getting over skis that I shouldn't be getting over. Is Eli Lilly expensive? Yes, it is expensive. Does it deserve to be expensive? Yes. Is it going to be an asymmetric stock from here? I don't know. Many things can be true here. This can be a phenomenally well-run company right now doing all the right things. And the thing that worries me with them, and the reason that I have not bought them, is the GLP-1 business in particular. GLP-1s are peptides, remember, but the peptide business more broadly is just getting really competitive. So retatrutide may be the next great thing, but there's going to be another next great thing after that, and it's probably not going to come from Lilly. So they're doing exactly what I would do if I was running the company. They're acquiring a whole bunch of really high promising treatments that could, provide really good returns in the future using that high stock price, but that's telling you everything you need to know. They think the stock price is high, and then management's trying to kind of insulate themselves from the value destruction when some of these patents run off in the future. What are your thoughts on owning market infrastructure companies like ICE, CBOE, and CME? It can be a really good business. I haven't even looked at now I lost my page. The multiples for some of these, ICE, for example, Intercontinental Exchange. Typically, those are pretty highly valued. No, I mean, that's pretty reasonable. 18 times forward earnings, 20 times trailing earnings. But the growth rate, is 8% over the last 10 years. That's solid. The question for some of these is going to be what happens with things like blockchains and prediction markets in the future. Yeah, could be really solid, kind of infrastructure businesses to own. Probably doesn't fit in the asymmetric portfolio because I don't see what the asymmetric upside is. But, so that's my just general thoughts there. Thoughts on Zoom. Seems like with all the AI disruption, this one is the one that can't be vibe coded away. Yes, there's also a ton of competition, and Zoom services are included in a whole bunch of different other products that you're probably going to buy before you buy Zoom. I think it's one of those businesses where if you got stuck in it during the pandemic, meaning your company built all their meetings on Zoom, You're probably not going to move to Google Meet or, Microsoft or whatever else. But there's a dozen companies that do this. I'm using StreamYard right now. I use Descript to record stuff. There's also Riverside. I know those are a little bit different businesses, but I just don't. I don't see what the disruption in the mode is. You're right. It probably can't be vibe coded away, but it can be a business that should be a feature and not a business. So I think that's generally the case. All right, I'm going to move on to a couple of other questions quick. My goodness, these are coming in quick. HIMSS, along with the lab offering, will start to have more and more collection of every consumer's biomarkers so that medications are custom suited, longevity as a service. Yeah, totally agree. The other thing I think they're going to include is all the data that we're collecting all the time. So I'm wearing a Garmin watch, I have a Garmin scale. That should all just hook up to HIMSS and HERS services. Have you looked at SNWV? I have not. So I will look it up right now. Sanuwave Health. Ooh, way too small for me. $50 million market cap. I'll look at it. Ultra Mist System. Looks like a mist system that I worked on. It's based near here. I wonder if this is something like what I worked on in college. I'll have to look at this. I don't think this is. Yeah, I did a college project that was something similar to that. But yeah, too small for me right now. Do you see Coinbase developing into a much larger financial infrastructure company? Is there anything you changed your thesis on recent performance and direction of the crypto market? Yeah, the way to look at it is crypto is infrastructure. USDC token, other stablecoin products, Base. That's the business there, and then just taking a small skim on disrupting the way that we buy and sell financial things. What exactly that's going to look like in the future, I don't know, but that's where asymmetric potential comes from. I did not read Chanos' short report on Coinbase, so I talked about neoclouds a little bit earlier. No, they're not going to make the portfolio. I just don't think there's a moat in that business. And we have no idea. We have no idea what the ROI is on those projects. Doing a press release that is telling you how much revenue you're going to have in the future doesn't tell me how much bottom line profit there's going to be. And when you're using debt to build out these projects, I just don't think that's a great position to be in. Why is Amazon so down? Not sure. Amazon's an expensive stock. Growth is slowing. Wouldn't be surprised if it continues to be volatile, but it's probably also running into the same thing that Alphabet's running into today. They're spending a lot on CapEx. Yeah, that's true. Google and Tesla are down because of those CapEx numbers. If this becomes an arms race, a CapEx arms race where everybody's building more and more and more, and eventually we're going to be oversupplied, and so those prices are going to have to come down, so the ROI is going to come down for all of these companies. That's not a good spot for anybody. So that's why some of these companies are coming down today. Nebius, AST, Zeta, not. I don't know, not. Nebius, not interested. Zeta, I have a small short position. Or sorry, AST, I have a small short position. I think that's a horrible business. There are multiple satellite providers, and that the number of people that are going to pay extra for satellite connectivity is really, really small. And most of the deals that they have, at least that we've seen disclosed, they get a revenue share. So great deal if you're Verizon. I'll charge you an extra $10 a month, $20 a month to get satellite access onto your phone. I get to keep 10. I don't have to put a thing into the sky. I don't have to do $1 of investment. AST's putting all that investment out there. Great growth story. It reminds me a lot of Plug Power. So you can look at how that one ended up. But I don't see how that. Telecom is a really, really hard business. It's a really, really hard business when you are the second or third biggest player and you're reliant on continual capex investment. Remember, those satellites don't last up there forever. They're going to fall back to Earth and burn up or become obsolete. You're going to have to keep putting them up. So I don't know. I'm happy to have them prove me wrong, but that is an incredibly highly valued company based on, I think, economics that are really, really questionable. Talked a little bit about now earlier. Bros. David wants me to buy into Bros. Coffee. It's coffee. I don't know. I don't know what to tell you. I don't until my wife tells me that they are the future of coffee. I'm gonna stay out of it. Private equity has a place in the market. There are companies that have been incredibly undervalued that just get bought out by private equity because the market doesn't figure it out. That said, I get why they have a kind of a bad reputation. But with something like I think this is in relation to the comments about Jersey Mike's. Just you don't have to buy the stock. You can just go buy a sandwich. Go buy a sandwich. It's fine. What do you think back to the Chinese AI? They're not as fast, cheap as the U.S. Get the same results. How can U.S. companies possibly justify the huge valuations? It's a good question. A lot of questions that are going to need to be answered in the future for a lot of these companies. This isn't to say that some of them aren't going to build really good and really big businesses, but you know, the way that these financial structures work typically is you don't sell equity in a company. So if you're Anthropic or if you're OpenAI has been a little bit different story because they were a nonprofit, but let's take a traditional structure. If you're raising, let's say $1 billion at a $10 billion valuation, you are actually selling debt that is it's a convertible note that converts into equity at that valuation. But if your valuation goes from 10 billion down to $1 billion, the investor gets their money back and the founder gets nothing. So, and the team and whoever else has equity in the company only, they get nothing. So that's the risk for a lot of these companies now. If you've raised $200 billion at a $1 billion valuation, and now suddenly the market collapses and you go public at $100 billion, everyone working there has nothing. That's why a lot of them are taking their exit liquidity now. They're taking that money out now. Yeah, I think that's going to be the question for a lot of these companies. That's why Alphabet was just the easy button for me. They got the money. Worst case scenario, you stop investing and then you just got a ton of cash flow. Pick two: Tesla, Nebius, AST, and Roblox. Cash. I pick cash. Many companies are afraid to give their data to AI firms. Will there be a scenario where profitable companies like Amazon, Adobe, Intuit have their own AI and just get better? Yeah, absolutely. Absolutely. That would be what's called a sustaining innovation, where, yep, this is really big, important technology that comes along, but it just makes the incumbent stronger. It doesn't enable a new round of innovation where the incumbents can't respond and the upstarts eat their business, eat their lunch. If you were Sears, right? Like you don't have the muscles to become Amazon. Sure, you can put up a website. I've said this about like Novo Nordisk, for example. Novo has Novo Direct, or Eli Lilly has Lilly Direct. You're not going to build a relationship with Eli Lilly. They don't have enough products for you. That's not what they do. They do research. So you're going to build that relationship with a company like Hims and Hers, which that's what they do. So that would be, kind of that example. That's one of the reasons that Intuit kind of does intrigue me, because if you're going to say, okay, I'll trust Perplexity with all my data, and I'm just going to have Perplexity do my taxes for me, why couldn't Intuit do that? And why couldn't Intuit just charge? I mean, if you can just take my data dump of stuff and charge me $100 to do my taxes and file it all for me, sign me up. Doesn't have to be part of my Perplexity subscription. Just sign me up. If that's what you do, I think there's a lot of people that be happily pay for that. All right, I'm going to cruise through a couple more of these, but I don't think I'm gonna. Maybe I'll get through everything. Today's GPUs are the floppy disks of yesteryear. Tons of competition ruined it for investors. The party got too crowded. Floppy disks. I've not heard that analogy. I'll have to think about that one. I like the phrasing. I don't know that it's a perfect analogy. It may be a little bit like fiber. But yeah, it if AI is more of a commodity than the market seems to think right now, that's going to be exactly right. Thoughts on Berkshire Hathaway? It's a fine company. It's a fine company. Um, they own great cash flow businesses. I just think expectations need to be that it's just going to be it's going to be a fine businesses. Um, yeah. Women love to spend money. Sure, that can be a fine investment thesis. It's not one I'm going to build my thesis around, but maybe it is like, kids are better investors than adults because they just make it simple. Peter Lynch's wife bought legs, pantyhose, and your wife on shoes. Some maybe that's the case. Any thoughts on NXE? I do not have thoughts on NXE. Sorry. All right, I got two questions here, quick, and then I'm going to get everybody out of here. So thanks so much for joining. So great to have so many questions. Uber and Lyft have a constant overhang of Waymo and Tesla eating their lunch. How long do we wait for a better price action? I don't know when that is going to shift. I think the big thing that needs to happen for both of those companies is some of this other supply has to come to the market. So that's going to be when does, Neuro and Lucid's vehicle actually hit commercial operations? When does Mobileye actually hit commercial operations? There's a half dozen or a dozen of these companies that are probably going to have some vehicles on the road in 2027. It's not going to be thousands of vehicles, but can you get to that point where, I mean, like Mobileye, for example, has 100 plus vehicles on the road today in both the U.S. in Austin and in Europe in Hamburg, Germany, I think is where they're operating. But they're doing that groundwork that Waymo did for years. Are they able to, then kind of accelerate faster once they get to the point where they're actually ready to scale the business? That'll be the big question. And if that happens, and you suddenly go from Waymo having, let's say they have 5,000 vehicles, that's ballpark about correct, to Uber going, okay, now we also have 5,000 vehicles and we're accelerating faster. That's when you, I think, would see a real shift. I think that's coming, but we're definitely not quite there yet. Since this is about him just now, I have needed to hear for a while. So thanks if I can be helpful. We'll see if that thesis plays out. So thanks so much to everybody for watching. Just quickly, talked a bunch about so you can rewind that. I will try to put some show notes in as well that goes through exactly when we talked about some of these stocks, and then also the price, stock price, if BPC is going to be passed. No idea. I think that could be a potential tailwind, but just don't know about what's going to happen with BBC 157. That I know is being discussed literally as I'm recording right now with the FDA. So I wouldn't be surprised to see that hit the market. Don't necessarily think it's going to be the massive driver that a lot of people think it is, because there's going to be a lot of players that are going to come to the market. But we'll see. Thanks so much, everybody, for joining here today. Like I said, if you are not already subscribed on Asymmetric Investing, there's a link on the screen. There'll also be a link in the show notes that I'll put in just a minute. Let me know. I'll try to do this once a month. Let me know when you have questions in the future. Thanks for listening. We'll see you here next time.